உங்க எல்லாருக்குமே நிறைய கேள்விகள், சந்தேகங்கள், அடுத்து என்ன செய்யலாம் அப்படின்ற ஒரு ஆர்வம், உங்க பர்சனல் ஃபைனான்ஸை எப்படி வளர்க்கலான்ற ஒரு சிந்தனை, இது எல்லாமே அதிகரிச்சுக்கிட்டே வருது. பட் இது எல்லாத்துக்கும் ஆன்சர்ஸ் ஈஸியாக கிடைக்குதா அப்படின்னு பார்த்தீங்கன்னா கிடைக்கல. அந்த ஆன்சர்ஸை உங்களுக்கு ஈஸியாக கொண்டு சேர்க்கறதுக்காக தான் ஆஸ்க் M2W எனிதிங்னு ஒரு ஹெல்ப்லைனை நம்ம கிரியேட் பண்ணியிருக்கோம். அதற்கான ஃபார்ம் இந்த வீடியோனுடைய லிங்க்லேயே இருக்கு. இந்த ஃபார்மை நீங்கள் ஃபில் பண்ணீங்கன்னா ஆட்டோமேட்டிக்காக உங்களால் நேரடியாக உங்களுடைய கேள்விகளை எங்கள்கிட்ட கேட்க முடியும். உங்களுடைய பர்சனல் ஃபைனான்ஸ் சார்ந்த சந்தேகங்களை நீங்கள் தீர்த்து கொள்ள முடியும். அது மட்டும் இல்லை, அடுத்தது என்ன செய்யலாம், யார்கிட்ட எப்படி ஆலோசனை வாங்கலாம், ஆலோசனை பெற்று எப்படி வளரலாம்ன்ற அந்த ஒரு தேடல்லையே நீங்க ஈடுபட முடியும். இது எல்லாமே உங்க முன்னாடி இருக்கக்கூடிய சாய்ஸ். இந்த சாய்ஸஸ் நீங்க சரியா செய்யணும்னா ஃபர்ஸ்ட் நீங்க இந்த ஃபார்மை ஃபில் பண்ணிட்டு ஆஸ்க் M2W எனிதிங் ஹெல்ப்லைன்ல பார்ட்டிசிபேட் பண்ணணும், அதுல ஜாயின் பண்ணணும். வாங்க இணைந்து பயணிப்போம்.
In this episode of Talking Straight with Mr. Shyam Sekhar, we're going to talk about how easy or hard is it to succeed as an investor. So for someone who's been so successful in investing, the question that's been on top of my mind is how difficult or easy has this journey been? I'm sure you've seen many investors over the years join this journey, and some of them would have been very successful, some of them would have abandoned it halfway, and what gets celebrated and documented are really just the success stories. But one thing that we've learned from Charlie Munger as an investor is to invert this problem and try to understand sometimes what goes wrong and then derive your success formula from there. So can we spend a little bit of time talking about those journeys where it's not gone according to plan and what has actually happened there?
See, firstly, investing is one discipline where nothing goes to plan. Everything goes against the plan. So, for example, you buy a stock, and once you buy a stock, what do you think? You think the company will perform well and you will start getting rewarded, and you will also start expecting the market to recognize what you have seen in the company. More often than not, the market doesn't see companies the way you see them. Sometimes you could have seen it wrong, which is always the case if you see in a hurry. Sometimes you would have seen it right, but the market will take time to see what you see. Now, this is more difficult than you're seeing it wrong, because when you're seeing it wrong, it's over, like it's one-sided, it goes one way down, right? But where you've seen it right, the market has not seen it. In that place, what happens is, first you start wondering whether you are wrong. I mean, it's natural, right? You buy a stock and it goes down 30%. What do? You have to make sure again whether you are actually wrong or you are right, but the market is needing more time. The problem of being early is a bigger problem than the problem of being wrong. That is something that I have learned. And when I look at people who actually left the market, which is after, selling their holdings when they go down, when I look back at what happened, I recognize that actually these could have been hugely successful people. They are good at spotting trends. They are good at spotting companies. But they were not prepared enough to hold on to their conviction against adversity or against Mr. Market's, erratic behavior. So that is where I think the differentiation between those who stay and those who quit begins. Okay. I would not say that, those guys are useless, so they left the market. It's not true. You look at all these portfolios of people who have left the market, they would have owned quite a few good companies, but not held them long enough, lost the opportunity to hold on for whatever reason, and force exited the market. For some circumstance or some circumstantial reason, they leave the market. So, if you are still there and we are having this conversation about what I think, if I am still present and relevant, I think it is because those circumstances did not happen to me. I was able to duck those circumstances or avoid them. Which brings us back to how do you do that? Primarily, when I came to market, I did not have the choice of failing, because if I fail, the familial consequence was very, very high. It's like, if you do something against the wishes of many people actually, because at that time equity investing was not a respectable pursuit, even as a hobby. It was seen as a gambler's activity.
Yeah.
So if you do something against what society thinks is respectable, unless you avoid failure, you are not going to a good place, you're going to a bad place. So that fear is what actually helped me a lot, to be honest. And that fear made me wonder where mistakes can happen, avoid all those places and go only where there would be no bad consequences. So because of going there, I was happy to get some good consequences and quickly too. And once you make money out of these consequences, which are good consequences, you still tend to go to places where you should not go. It's always a problem as an investor. So you will go to one or two places which you should not go. But that fear that, if I fail, it will be worse than what anything else can be, always will make me walk out of those bad places into a slightly better place and then look for an even better place. So that fear is there. Even today it's there, because today it's not just my money, it is fiduciary capital. In fact, as an investor, most of your work is working on this fiduciary capital. It could be family money, it could be customer money, it could be public money. There are a lot of trusts, educational trusts whose money we invest in. So the responsibility is so high that you always think of where there can be bad consequences and try your best to avoid those places. So it is that fear which basically gives you survivorship, and it is not any other great skill. It's just that you don't want to do something which is not going to look good and which will make you look very bad in the eyes of people who have trusted you in some way or the other. Earlier it was people who are going to judge you. Now it is people who have trusted you, and when they trust you, they have a right to judge you. So it's the same thing in another form. So circumstances change, but the principles remain. They don't change much actually.
So that's a very interesting way of looking at things, because normally when we hear investors talking about fear in the markets, it's more something that results in bad consequences and missing out on the action. But here, like, fear has actually played a very pivotal role in making sure that you end up with good consequences. And there is a lack of fear in today's markets, because when we talk to young investors, when we talk to people who come into the markets, there's a lot of aspiration to make it big as investors, but a slightly reckless or even oblivious attitude towards making these decisions. But there is a need for a certain level of both emotional as well as financial preparedness when you're planning to create larger sums of wealth. And so what do you think really goes into that? What are the processes that are there? What are the tools that you can use to actually make sure that as a DIY investor, you're making it big and you're following some level of discipline as well?
See, I think if you are going to build your own portfolio, then you need to understand a few things before you go on that path. The first one is how do you select investments? How do you make choices? The second one is how do you use those choices to build a portfolio? The third one is how do you manage the portfolio? Because there are going to be changes. You buy something, something goes up, something goes down. How are you going to adapt to all these changes? Something goes up too much, something goes down too much. How are you going to respond to that, to both situations? So you have to learn these basic things. And then when do you sell? What do you do with incremental capital? Where do you find incremental capital to invest in new ideas? What do you do when the going becomes too good? Should you sell or should you just sit? So these are all some simple things in which a DIY investor must have a clear thought process. Now there are no textbooks to precisely teach you that in the Indian context. There are a lot of things in the global context. You cannot import those straight into India. Some principles apply, they are always enduring and everywhere, relevant everywhere, but not all. So you take those principles which you read outside in textbooks, but you also learn how to do it practically. there are opportunities to do vicarious learning, like observe somebody else do it and learn. So that is one way of learning I think you can do. So you have somebody who's doing it well and you follow them. I found one investor who is today a very large investor doing it very interestingly. He would invest in mutual funds and understand the mind of the fund manager and why he is making decisions. So he used to always dig into them because he was a HNI, everyone will come and meet him, will ask questions. So slowly he started learning how fund managers evolve a style and then talk to different sets of people. So slowly understand different styles. While understanding different styles, the investor recognizes what is his style. Who am I? That answer comes. And then once you realize who you are, you try to grow your style. So this is one way of doing it. The other way is learning principles, applying them yourself, making mistakes, and developing and honing your skills and your principles to become a better investor with every passing year. You have to become a better version of yourself. This looking at other investors and then becoming a good investor is what popularly is called as the sidecar investing or cloning. They take stocks from different portfolios and do it. Today I think cloning is a religion actually. In previous cycles it was a cult. Today it is a religion. But I am not a fan of the cult or the religion that cloning is. I feel that you must individually develop the investor that you want to be. You must evolve into that. So it takes a little more time in my opinion, but it's definitely more individualistic and it's like you writing your own book rather than plagiarizing somebody else's book or you composing your own song rather than taking one tune and developing another one like that. So the difference will be very stark. So that individuality is something that I treasure more. But you can do it with all individuality or you can do it with cloning also. Both options are there before you. You decide what you want to be. That is what I would tell anybody who's asking me this question any number of times.
So, I mean, that's a good way of looking at it because you can clone, you can follow somebody's style or you can craft your own style. And we started off this conversation with the inversion, right? Meaning what has not actually worked for investors. Can we also spend some time talking about some success stories that you've seen over the last few decades, what they've done right in getting them to the next level?
See, I think investors first start as traders. They want to make money. And once they make money, they look at what can I now turn myself into. Then they want to make big money. First you want to make some money. Then you want to make big money. It's very normal. Every person that I have seen has seen this migration from making some money to making big money. When they want to make big money, then they start looking at better ways than just trading. So then they see, can I buy a position in a company which is large, which I will hold for a very long period of time, and that money will work for me. So they take the trading money and put it into investment and think whether that company which they invest in will do a better job than their trading, right? So that is why you will find the trader may buy and sell stocks very fast, but his investment he will protect fiercely. Okay, and there are some glorious examples like Mr. Rakesh Jhunjhunwala or Mr. Radhakrishnan Damani. There are many people, even around us there will be a lot. You fiercely protect the investment position because you know it will do better than your trading.
Correct.
So you migrate from making some money to making big money. And then from making big money, you try to find a way to make very big money, which is by buying very high conviction positions in very early stage opportunities. It could be a startup, it could be a venture capital, it could be a company that listed at a good valuation and because the valuation was high, fell and market lost interest. So you get it at a very cheap valuation. It could be a company which is out of favor because of some circumstantial factor and those factors could deem to be temporary. Your US FDA troubles could be a good example. Then companies rise from that to become much better companies. So like this, you look at special situations in very good investment opportunities which have a longevity and a runway and the size of the opportunity to make you very big money. So, some money to big money to very big money. When you do this transition across these three phases, your whole outlook towards investing will evolve and change. It's not that you will not trade again. When we say three phases, people think that somebody shut down one phase and then went to phase B and then phase C. When they are in phase C, the phase A and phase B cease to exist. It doesn't work like that. They are concurrent. But a bigger part of your life should become the more material part. So you evolve from one to another. You still are that phase A person who still tries to make some money somewhere. You still are that phase B person who tries to make big money somewhere, and you are also the phase C person who is trying to make very big money in some place, and you know where you can do which thing. So you are always trying to position yourself in all these buckets. It's not as if one phase of your life ceases to exist. Like you never break up with any phase. You are having three relationships concurrently and you are actually working on all three. Some relationships with investments don't mean so much to you as others. So you have to compartmentalize and segment it in your head very clearly. You must not mix them up also. Sometimes you go and buy a stock wanting to make some money, and as you study, you start seeing an opportunity to make big money, and then you move it into the next bucket. And then as you are seeing big money, you are seeing that it can continue to make very big money for a very long time, you move it to the third bucket. So, you evolve along with your investment. As you own the investment, you evolve. And you adapt to the circumstances, adapt to the context, adapt to what the investment is telling you. And your being able to adapt is your ticket to growth. So this is phase A, phase B, phase C. This is how you go.